Grant Patterson, who's the CEO of Massmart. Grant, thanks very much for joining us as well. These are the first numbers, of course, under the auspices of Walmart. You are a subsidiary of them now. The interesting thing that we've just been talking about with Liston, one of the things we've been talking about, Grant, is inflation now at 4.9%. I think your inflation for the year came in at 1.8%. That sort of impinges your margins, doesn't it?
Yes, it actually makes life very difficult for us, and it's been going on for some while. I think if one look back 4 or 5 years, you'll see that product inflation is much below CPI. And of course, all costs go up related to CPI. So we have to sell more boxes just to sell the same place, and selling more boxes and moving more boxes costs more money. So it does put pressure on margins, you're right.
Let's have a look at these numbers now. Headline earnings, it says here, increased by 38%, and headline earnings per share, Grant, increased by 30.3%. Adjusting, however, for the effect of the Walmart costs in both years, they are reduced to 8.9% and 2.8% respectively. But that's out the way now, presumably.
Yes, correct. The accounts are a bit complicated because of the transaction, but you know that's behind us. The transaction's implemented. We're moderately happy, maybe a little bit disappointed with the core profit growth, but we are happy that it is reflective that we're investing heavily for the future. Cost pressures in occupancy and depreciation, which are related to new stores and capital expenditure. We think that's going to carry on for the next 18 months. So we're going to a half year that's going to be a full year, and we're going to change year ends. And then I think from the full year of calendar year 2014 onwards, we're going to start seeing the margin growth that people expect out of the Walmart ownership.
Okay, well, we'll come to the prospect statement later on, but essentially you're saying no margin increase because of the expansion, etc. Also, I think because of competition, there is fierce competition. People sort of starting to come into your space, if you like. I mean, you saw the ShopRite Holdings numbers yesterday. You must be taking this quite seriously.
Well, you know, ShopRite, you know, certainly the market leaders, and we've got huge respect for them. They're fundamentally food retailers, and we're not really in that business much yet. We're quite small. We're only a 9 billion rand annualized food retailer. But I think your point is quite correct. There's competition everywhere. 2 years ago, when everyone found out that Walmart was coming to the market, all retailers came up with a plan and a response to that. And whilst the competitor set has been responding over the past 2 years, we've been focusing on completing the transaction and integrating with Walmart. But that's behind us now. So we're focused back on the customer. We're focused back on the operational detail. We've got a very clear strategy, and we're going to expand and grow fast.
Sales up 15.6%, operating profit up 21%. That is before the rather complex accounting issues that you alluded to earlier on, Grant. What about costs? Costs seem to be extremely high, just under 20%. What's the main reason for that, and are they starting to concern you?
Well, what you're seeing is the complex accounting. So let me try and give you the more simplified cost pressures. It is true that we have cost pressures. Comparable costs, so for the comparable business, are only up 7% though, so reflecting a well-controlled business. New space, and we've added 7.9% new space. That new space is expensive, so that's caused the costs to go up. And then we've opened a number of DCs in the last 2 or 3 years. And those DCs are, of course, non-trading space. They just add to the costs. So you're right, there is a cost base increase. We think that hurdles around about sometime during the 2013 year. And then we start extracting the productivity that we need out of those investments.
So it almost looks as though everything's being lumped in. It's been lumped into the last year or so. It's going to be lumped into the next 18 months with these distribution centres, etc. But after that, once everything's in place, you'll be in a very, very strong position, economy allowing, to reap the benefits of all these initiatives.
Yes, we've done 2 significant things that need highlighting over the past 3 years. One is we've launched investment in distribution centers and supply chains and computer systems to turn ourselves into a modern retailer, world-class retailer. And the second thing is we've launched an ambitious strategy to become a food retailer, to add 3 new food retail brands to the South African market. Now, the South African retailer is a well-serviced market, food retailer market, and that's an ambitious plan. And so we expect that to be hard and produce low returns in the short term.
Okay, let's have a look now at the various divisions of yours. You've got Mass Discounters, Mass Warehouse, Mass Build, Mass Cash. Which underperformed, which overperformed? What was the situation over the last year?
Well, let me do that, and let me use the more popular brand names. So the business that did the best was Builders Warehouse. It's really a spectacular year, and that in the face of, I think, a rather mediocre housing market. So clearly consumers are voting for that brand, and they also are investing in renovating and improving their homes. Whilst they may not be building new homes and moving much, they certainly are investing in their new homes. Second best performer was the brand known as Makro. Opened 2 new stores, launched a whole new category of fresh. Fantastic year. Opening up those big boxes is very expensive, but Cape Town now in Montague Gardens enjoys a new store, Nelspruit enjoys a new store, and Polokwane enjoys a new store. So they did very well. Then not so great, but all right, was Mass Discounters, which is the people knows the 2 brands, Game and Dion Wired. Game had a difficult time in South Africa, but fantastic in Africa, and Dion Wired really performed well. So that gave us a sort of middle-ish performance. The poor performance came out of our Mass Cash business, which is the wholesale and retail food business, and that's really where all the investment's going. Investment in brand, investment in price, investment in people, and investment in assets. So that performance there is largely attributable to that investment. A few small mistakes, but nothing that we can't fix.
Yeah, that Builders Warehouse story is one that's quite pertinent to me, because every time I try to go to this market, which is located in Cape Town next to Builders Warehouse, I can never get into the parking because everyone's queuing up to go in there. Let's have a look at your prospects, and also actually something that is not included in the results but is more pertinent to what's happened up to the 19th of August. Your 8 weeks of figures up to the 19th of August, which you've kindly given us. Sales up 17.7%, and also comparable sales up 9.8%. Seems to be accelerating. The consumer seems to be in pretty good health in South Africa.
Yes, caught me but by surprise as well. I can't exactly explain it. You know, it may be market share growth, or it may be the consumer doing well. We'll have to wait for the national stats to come out and explain to us why. But you know, as a retailer for the moment, we don't really worry too much why. That's good news for us, and we'll try and respond to it.
I hope that all this spending is for the right reason. I was speaking to Jacko Marie of Standard Bank the other day on the occasion of that institution's results, and we were talking about unsecured lending, which at that bank had gone from something like 700 million up to 3.4 billion. That's people earning a monthly salary of 8,000 Rand or less. I hope they're not borrowing in order to consume. I mean, I hope they're borrowing in order to improve their houses, which is good for you anyway because of Builders Warehouse and your other brands. But if it's improving houses, or if it's children's education, fine. But if it's just to be able to survive, it's not so fine. What is your understanding about the consumer's behaviour in terms of that unsecured lending space?
Well, remembering that unsecured lending is highly regulated. So you know, it's not possible to overlend. Well, not if you stick to the regulations. But what we are seeing, because we have our own private label or white card, it's called credit card, a Game credit card, a Builders card, even a Makro, you can get a credit card. We can see in there that like-for-like card spending is down perhaps as much as 30%. So that's exactly right, that those consumers who rely on unsecured lending have pulled back. Whether or not they're pulling back because they've run out of money, or they are tightening their belts, I don't know. On top of that, what we're seeing is more cards being issued, so applications for cards going up. Both are, I think, warning signs that there is perhaps pressures in certain segments, perhaps the middle income segment of the consumer, and we should pay attention.
Very, very quickly, last question, Grant, I promise. It's the Walmart people. Are they good to work with? Are you getting on? Is the integration complete? Or I know it's obviously an ongoing thing, but are you satisfied?
It's perhaps one of the parts of the transaction I'm most pleased at. You know, when I went into this process that started 2 years ago, all the good advice said, Grant, this is about people and relationships. It's not just about numbers and bashing 2 businesses together. And I think, you know, Walmart has a lot of experience of buying businesses, and they've been fantastic. That's not to say we haven't had our moments with them, but as we sit now today, we have an excellent relationship with Walmart. We're well integrated. We can speak the language. We understand the processes. And I think we're really starting to benefit from the ownership. And I think we've made good decisions about what to integrate and what not to integrate.